I remember like yesterday, the 1987 Black Monday crash. It was my second year in college, and my friend's older brother just lost $80,000 in the stock market. That was an unbelievable amount of money to me at that time. And I wondered, why would anyone risk their hard-earned money investing in the stock market? Then I wound up working in the industry, and I lived through several other crashes. One of the big ones that comes to mind is the dot-com crash. That was in the early 2000s when the NASDAQ Comp Index, which mostly represents technology stocks, went down a total of 77% off of its high. Then there were the horrific events of 9/11, the Great Recession, and of course, the COVID-19 crash. Through every one of these events, many investors could not take the losses and wound up selling their portfolios at the very lows in the market. This is understandable, since every single news event sounded like the world was coming to an end. One day during 2008, I counted 58 negative comments within a 1-hour period on one of those major finance networks. At times, you almost feel foolish saying anything positive about the market. But some of the worst damage done during the market crash is when people sell their portfolios at market lows. The fact is, folks who just went about their business and held on to their diversified portfolios through all of these crashes and systematically made monthly purchases at the highs and lows in the market, even through all of these horrible events, these are the people who wound up with substantial gains over a very long period of time. Sometimes it's best to do nothing. It reminds me of that Alice in Wonderland quote, "Don't just do something, stand there." Even through all the historic disasters over the last 2 centuries, stocks have returned approximately 6 to 7% after inflation, which nearly doubles the purchasing power of a stock portfolio every decade. But you have to be patient. The power of time and patience is key. Building wealth happens gradually and then suddenly. Gradually, with the monthly savings, with stashing away work bonuses and stashing away tax returns. And then suddenly, when you look at your account statement after investing over about a 30-year period. Looking back, that 1987 crash that I remember in college is so profoundly insignificant. If an investor at that time was in the S&P 500 and just held on, their money would have gone up approximately 20 times since that time. I always enjoyed listening to Jeremy Siegel, who says, "To be a successful long-term investor is easy in principle, but difficult in practice. We are all vulnerable to emotional forces. But if you don't let emotions dictate your investment decisions, you can build your retirement savings gradually and then suddenly through long-term and disciplined investing." My name is Nicole McGrother, and I am a financial advisor with Banyan Wealth, Raymond James.